The harsh truth is that most people don't trade profitably, and I believe I found the reason why. Before watching this video, subscribe and like. Because when we look at charts such as this one, and in retrospect, we will always see opportunities on how we could have profited from them. So for example, there's been a downtrend right here, evidently by the lower lows and lower highs. You could also draw a trend line, although that's more of an art than it is a science. We are going to do this anyways. So this would look something like this. Now, they see that the trend line has been broken and that the chart makes a new higher high. Just as well, there's a moving average crossover, meaning that this is very indicative of a trade reversal. Some of you will have taken a position right here. This is the Euro-US dollar in the daily view, by the way. But many of you are also going to combine this with a momentum indicator. So in this case, I have the stochastic oscillator plotted on right here. And what many people would do is they think we maybe can't catch trends effectively when they are turning around, because there's a high risk of getting stopped out before the trend actually takes on, or it may be a false signal. And so what they will do is they will look in the trend for opportunities to enter the trend because it's oversold. Because think about it, it is very risky to buy at overbought levels, just as right here, or just as right here, that the market is going to go down. But if the trend aligns with a oversold level, such as right here, then we can see that the market did correct up again, approximately at these spaces. And so through this way, many people develop strategies in retrospect, and the strategies appear to work extremely well. I mean, look at this. For example, if you had followed the trend following strategy of just the moving averages, all of these are bullish at this point, and there's been a volatility breakout in the same direction as the trend is going. So this would have been a very profitable trade. I mean, let's say you would have entered here and exited at oversold levels. That would have been 6%, and your risk would have been something like 4%, so that would be 1.5 times your risk multiple. This may be 3%, maybe 4, 5, 6%. That will depend on your risk appetite. But to come to the point of the video is that many people will then look at the chart in ranging markets, and when they apply that strategy that I have thought of before in the trending market the same way. When in reality, for example, looking at the moving average crossovers, it doesn't work in ranging markets. I mean, look at this. There's lots of mixed signals right here. If here you go and say, all right, it's oversold, just barely, even not really, but let's say you assume this, then in this case, you would take a long position. But previously what you have done is you assumed you would take the trade until the very end of the trade, until some favorable condition happened, so that in retrospect your trade would have been favorable. But now you're looking at this and saying, all right, it's oversold, or it has been oversold, and the market corrected back again. So I would not have taken this trend because it's not below 20. But then in other situations where it did went below 20, then what will need to happen for your trading strategy to determine whether it works or not is you will need to have the same exit rules. Many people apply different exit rules in retrospect and therefore think that the trade works, when in reality the market was just moving, and you in retrospect said, I knew that this would happen, so this exit would have been good. For example, right here, then by the moving average crossover exit, this would have been barely profitable at all, right? It's a 1-to-1 risk reward ratio. That's not really the thing that most traders are looking for. But then if you're testing your strategy, which you call trend continuation, because this would be trend continuation if you assume that there's a trend, well then guess what? This, if you define this as a crossover, or this would need to be your exit here in this case as well. If it wasn't, you're just lying to yourself. That's why it's one of the golden rules of Forex trading, of trading in general even, to have a clear rule set and to test your strategy according to this rule set. If you don't, well then you can get lucky, but it's just going to be that. It's going to be luck. So now we know that we need consistent exit rules for the same strategy. Otherwise, we would be deceiving ourselves. So what I've just told you, I've basically summarized for myself in my Notion. Yes, you can read through this if you want, but it's not going to be anything new really. This is in my trading operating system. I just created this. It's something new that I'm working on. And the way that I notice it is actually by testing my strategy right here, which I'm not going to show you now, but that's how I noticed. All right, if we don't have the exact same exit routes for the same setup, it's going to be very problematic. Let me know your thoughts in the comment section. I will read through all of your comments. Subscribe to the channel, leave a like, and see you in the next video.